All right, Accounting 2 kiddos, welcome to our first section in our advanced accounting book. The nice thing is that where you were definitely sprinting before, we are going to kind of go back to a light jog, do a little bit of review of Accounting 1 stuff before we get going into managerial accounting a little bit more later on. So in 1.1 today, we're actually going to go back, revisit our relationship with our accounting equation, and then also talk about the relationship between the subsidiary ledgers and our controlling accounts. So up until this point, remember, we've been working with financial information, and we know that it can be recorded and summarized and reported in a variety of ways. You guys have done that all throughout our first accounting book. Accountants are meant to design accounting systems to meet the specific needs of their business, and the way in which that information gets kept and reported in that system is determined by how big the company is, what type of company it is, and also the complexity of the business. Do they do international sales? Do they do sales online? Are they just a simple proprietorship? That will determine how that information is used. And when we design our financial records for our business, we also need to consider the type of decisions that are going to be made based on our financial statements. Are those financial statements going to be used for people outside the business, or are they going to be used for people inside the business? So if managers of individual departments want to use financial statements to assist in making decisions, that information for each department has to be recorded separately. And that's something new that we're going to look at in this chapter. So the types of information that could be gathered by departments could be things like you might have a specific purchases department, you could have a specific sales department, and you could have a department specific for expenses. Another department might be for payroll, so dealing with salary. So when we start gathering information by department, it's going to require us to have a bit of a different set of accounting procedures, which are going to look a little different than what we've done before. However, regardless of the accounting procedure that's used, the same accounting concepts and practices are going to be followed. So you're going to hear a lot of the same terms that you've heard throughout Accounting 1, and that's why we just go back and do a little bit of a review here before we get started. So if a business decides to record information by department, it first has to establish procedures to ensure that those transactions are going to get assigned to the correct department. We obviously wouldn't want a purchases transaction to be recorded in payroll or an expense transaction to be recorded in merchandise. So we'd want to make sure that they get in the correct departments. So our chart of accounts has got to contain some departmental information like purchases, sales, and salary expense. So here's just a quick review of our accounting equation. Remember, we have assets equaling liabilities and owner's equity. Remember, assets are anything of value that is owned by a business. A liability is any amount that is owed by the business. And the difference between those are owner's equity. In a corporation, of course, we call that stockholders' equity. Hopefully, that is nothing new for us. So then going back to our accounting records, remember that our account records are going to show changes in the current account balance of each asset, liability, and owner's equity or stockholders' equity account. And anytime that we're going to journalize those changes, we need to make sure that we have source documents. Remember, source documents are simply business papers from which the information is obtained for a journal entry. They could be checks, they could be memorandums, they could be receipts, sale invoices, calculator tape, etc. Remember that each journal entry has to be supported by a source document to prove that the transaction did occur, and that the source document is the original business paper, and that we use them to make sure that the amounts recorded in the accounting records are accurate and true. So that brings us to remembering that everything we've learned so far has been done around double entry accounting. Remember, double entry accounting simply means that we record the debit and credit parts of a transaction. And so with double entry, obviously double means two. It means that every transaction has to affect at least two accounts in order to be correct. So the two accounting principles that are common to double entry accounting, the first one is essentially the accounting equation. It says the total value of things owned by a business, which are the assets, equals the total value of claims of outsiders, which are our liabilities, and the claims of owners, which is our owner's equity. which if you read that right, it just means that our debits equal our credits for each business transaction. So we record everything in a journal. It's the chronological form we use to record. The first one we were introduced to was our general journal. It can be used to record every single business transaction if you choose to do it that way. Remember that our general journal includes columns that record dollars and cents. That's just the accounting concept of the unit of measure. And that obviously it has the two amount columns for debits and for credits. Left is debit, right is credit. And then starting in chapter 9, we started working with our special journals. And remember that a special journal is simply a journal used to record only one kind of transaction, especially if you have a business that goes through several daily transactions. It's best to use a special journal just to keep everything in its rightful place. So typically, businesses will use 4 special journals along with their general journal. Those 4 special journals are purchases journal, cash payments, sales, and cash receipts. Remember that purchases journal is used for only making purchases of merchandise on account, and sales is for only the sales of merchandise on account. Those are 2 very important words to remember when we're looking at our purchases journal and our sales journal. So remember that we journalize all of our transactions in chronological order, and that every single transaction affects 2 accounts. Remember, accounts are a record that summarize all the transactions pertaining to that single item. So here are just some examples of different accounts we would have. We've got assets, liabilities, stockholders' equity or owner's equity, any revenue, and any expense. Remember that they increase on their normal balance side. It could be a debit or a credit, and then obviously they would decrease on the opposite side of that. So in addition to our general journals and our special journals, we also have ledgers. So our ledgers are simply a group of accounts. Our general ledger is a ledger that contains all accounts needed to prepare a financial statement. So our general ledger is going to include things like all of our assets, all of our liabilities, all of our expenses, all of our revenue, all of our owner's equity. And you also might have a specific ledger that's used to summarize a single general ledger account. So you could call that a subsidiary ledger. We have 2 of them that we've worked with before. We've had an accounts payable ledger and we've had accounts receivable ledger. An accounts payable ledger is for all of our vendors, the people that we buy product from on account. And our accounts receivable ledger is for all of the individuals that purchase merchandise from us on account. So those are called controlling accounts, accounts payable and accounts receivable. And then everything else in between that would be considered a subsidiary account. So this just shows an example of the accounts payable ledger. Here are all of our examples of our vendors. So you can see that we owe Backyard Furniture $4,300. Delmer Industries, we owe $2,600. And if you total all of those up, you can see those are in our accounts payable ledger. That totals $23,877.61. And that total is the total that goes in our accounts payable. Notice that this is in our general ledger under our liabilities. So our accounts payable total is made up of all of these different subsidiary accounts, and accounts payable is our controlling account. The last thing just to review is making sure that we do file maintenance correctly. So remember that file maintenance simply is the procedure for arranging accounts in a general ledger. So we talk about that we have our first number, which is for our division, whether we are assets, liabilities, owner's equity, or stockholders' equity, revenue, or expenses, the category that we're in, and then the location within that category. So we want to make sure that when we are assigning file numbers that we're doing that correctly. So that brings us to the end of our lecture. That will actually hopefully be a nice little review for us when we go and head over and do our work together in Applia. So I will meet you over there.